In a world that can feel pretty uncertain, we're all looking for some kind of security. It's just a basic human instinct. We all want a safe harbor for when things get turbulent. Well, today, we're diving deep into one of the oldest, most trusted safe harbors of all time: gold. Seriously, just think about that for a second. How do you prepare for the unexpected? Whether it's a small personal emergency or something way bigger, we all have some kind of plan, right? Or at least we've thought about it. That impulse to get ready for a crisis is totally universal. And a lot of the time, that preparation starts with the physical stuff. I mean, we're seeing it more and more, right? Big storms, power grid failures, things that can turn our daily lives upside down in a flash. Being self-reliant becomes absolutely critical in those moments. So, what does this whole quest for security actually look like in practice? Well, if you ask the experts, it really starts with the absolute basics. Look, it's not just us saying this. Big agencies like FEMA and the American Red Cross are really clear about it. Every single household should be ready to get by on its own for at least 72 hours. And that means having the essentials: food, water, first aid, shelter, packed and ready to go. So, okay, let's say you got your go bag packed. Your emergency supplies are all sorted out. You're set. But what about your money? How do you protect your wealth, your actual purchasing power, when the economic systems themselves are the ones under stress? Now that is the million-dollar question. For thousands of years, whenever a financial storm was brewing, humanity has turned to one specific asset for shelter. Yep, let's talk about gold. Gold's reputation is really built on three huge ideas. First, it's a reliable store of value. Second, it's a hedge against inflation. And third, and this is crucial, it's seen as a safe haven asset, the thing people run to during a crisis. And that term, safe haven, is so important here. A safe haven isn't really about getting rich quick. No way. It's about protecting what you have when other things, like stocks and bonds, are tanking. It's all about financial defense. But a reputation is one thing. Performance is something else entirely. So does gold actually live up to the hype when the going gets tough? Let's put this whole safe haven idea to the test and look at the real numbers. Okay, so one of gold's biggest claims to fame is as an inflation hedge. The logic here is actually pretty simple. As the value of your cash goes down because of inflation, the value of a scarce physical thing like gold should go up. This chart just illustrates that point perfectly. See that dotted line way up at the top? That's gold. The lines below are major currencies, like the US dollar and the British pound. After the US cut the dollar's tie to gold back in '71, you can just see how those currencies have generally lost value over time, while gold has trended up. And notice that huge spike in gold's value around the 1973 oil crisis? That's a textbook example of investors running for safety. But, and this is a really important but, there's a catch. While gold often does great when inflation is high, it can actually struggle when central banks decide to fight back by jacking up interest rates. See, higher rates make other investments that pay interest look more attractive, and that can create headwinds for gold. We saw this play out in the early '80s, and we saw it again in 2022. Now this slide, this is where you can see just how differently gold behaves when there's a real shock to the market. I mean, look at the global financial crisis in 2008. The S&P 500 lost almost half its value, while gold gained almost the same amount. In every single one of these crises, you see the stock market taking a massive hit, and you see gold delivering positive returns. The difference is just stark. So let's boil all that data down to one single number. Across 10 of the biggest market crises in recent history, while the S&P 500 was losing an average of 22%, gold gained an average of 11.5%. That right there is the safe haven effect in action. Okay, so gold clearly shines when things are going badly, but what does that mean for your portfolio the rest of the time? Let's take a look at how it can actually fit into a long-term strategy. The key idea to understand here is correlation. It sounds like a fancy word, but it just means how closely two different investments move together. And as you can see here, gold often moves to the beat of its own drum, totally separate from stocks and bonds. When they zig, gold often zags. And that lack of correlation, that's what makes it such a powerful tool for diversification. And here is the real-world result of that diversification. This chart shows what happens to a portfolio over a 20-year stretch. And you can see it plain as day. Adding just a 5 or 10% slice of gold led to a way higher final value compared to a portfolio with no gold at all, growing to well over $300,000 with that 10% allocation. So, what's the big takeaway from all this? Adding gold to a portfolio can act like a stabilizer. It helps cushion the blows during those nasty downturns, which reduces your overall volatility. Think of it less as a tool to get rich and more as a tool to stay rich, especially during a storm. All right, the case for having some gold in your corner is pretty compelling. But how do you actually do it? How do you own gold? It's not quite as simple as just buying a share of stock. So, broadly speaking, you've got two main paths you can take. You can own actual physical gold. We're talking bars, coins, that kind of thing. That gives you direct ownership and control, but you have to think about storing it and insuring it. Or you can own virtual gold through financial products, which is super convenient and liquid without the physical hassles. For most investors, let's be honest, the virtual route is just way more accessible. Gold ETFs are incredibly popular because they trade just like a stock and are designed to track the price of gold. You can also look at mutual funds that invest in a whole bunch of gold-related stuff. Or you could even buy stock in the actual companies that mine the gold, though that does add a whole other layer of risk to the equation. So we've looked at the history, we've crunched the numbers, but gold isn't just some dusty relic from the past. It's an asset that's actually evolving and facing brand new questions in our modern world. I mean, investors today are asking, where did my gold come from? That's pushing the whole industry toward more sustainable and ethical mining. And on a personal level, if you own physical gold, you really need to think about your estate plan to make sure it gets passed on smoothly. And finally, you just can't ignore technology. New digital and crypto-based products are making it easier than ever to own and trade gold. Which brings us right back to our big question. The data is pretty clear. Historically, gold has been a powerful defensive tool and a great way to diversify a portfolio. But in a world of digital currencies and super complex financial markets, does it still have that same magic? Is it the ultimate financial insurance policy, or is it a golden tradition whose time has passed? That's something every investor has to think about for themselves.